Watching Bill Hwang's Archegos capital management hedge fund stumble triggers more traumatic memories than global finance veterans like to admit. For many, parallels between the 1998 blowup of long-term capital management and Hwang's forced liquidation of more than $20 billion worth of stocks on March 26 were too strong for comfort. The details differ, but the underlying forces, heavily leveraged positions colliding with the hubristic belief that past crises can't happen again, are essentially the same. And, unfortunately, another LTCM-type crash could be next. That's the message Nouriel Roubini is taking to television screens and podcasts around Manhattan, where the economist teaches at New York University's Stern School of Business. It's not easy to ignore Roubini, who's among a very small group who can credibly claim to have predicted the 2008 global financial crisis. We do often, however, wish he were wrong. Sadly, Roubini seems to be onto something as he warns ultralow to negative borrowing costs across the developed world and epic fiscal laxity pushed risk-taking into the stratosphere. Price-to-earnings ratios, cyclically adjusted, are, by Roubini's calculation, the highest since both 1929 and the early 2000s. We're seeing widespread frothiness, bubbles, risk-taking and leverage, Roubini told Bloomberg last week. Lots of players have taken too much leverage and too much risk and some of them are going to blow up. Roubini, who's known as Dr. Doom, thinks the most obvious trigger will be U.S. Treasury yields rising above 2%. That could panic investors in all asset classes, sparking powerful waves of selling. That's especially so here in Asia, the region with the largest U.S. Treasury debt holdings. It could take on a momentum all its own, driving up rates on corporate, mortgage-backed, asset-backed and municipal debt. A jump in yields would force big revaluations of equity prices, too. This surging Treasury rate scenario also spooks analysts at Goldman Sachs. Scott Minard at Guggenheim Investments worries more Archegos-like shocks are possible as 2021 unfolds. And the prospect is sending waves of anxiety Tokyo's way. Hwang, a South Korean-born New Yorker, has a rather unusual background. In 2012, the alumnus of Julian Robertson's Tiger Management hedge fund was essentially blacklisted after pleading guilty for insider trading. Family office Archegos, founded in 2013, was his comeback play. Last month's reckoning put a spotlight on global banks that started dealing with Hwang again, seduced by lucrative trading commissions. They include Nomura Holdings, Credit Suisse Group and Morgan Stanley. Since then, Nomura has been warning of significant losses. Its initial estimate was about $2 billion. Mitsubishi UFJ Financial Group joined the list of global players facing big losses. On April 2, Japanese Finance Minister Taro Aso said the government is looking into losses incurred by Nomura, Mitsubishi UFJ and potentially other Tokyo giants.